Okay, introducing myself on academic level, I have a BS degree in computer science, a master's degree in finance, a master's degree in management. I have a certification in anti-money laundering, another certification in operational risk, and another certification in corporate, commercial, and international law. On professional level, I have 25 years of consecutive experience in the banking sector. 20 years of them is with Standard Chartered Bank. I worked in the cybersecurity. Then I work in the banking and finance, in the operational risk, in the compliance, in the anti-money laundering.
Nice.
And for the last 10 years, I am a consultant with PwC and 7 other institutions which are active in the MENA region and the GCC. Fine. I'm elaborating about the PEP and the RBA. PEP, I'll be elaborating a very simple idea, and then I'll be moving to the RBA. About the PEP, the politically exposed person. Since more than 20 years, since 11 of September, when there has been focus on anti-money laundering, combating the finance of terrorism, there is a question we always ask. When someone is supposed to be a PEP, when someone is supposed to be a PEP, for how long shall we keep him a PEP? For how long? Suppose someone is a minister, and he is no more a minister now. So we considered him a PEP because he is a minister, and now he is no more a minister. So for how long have I to keep him on my system as a PEP? The very simple answer here is the following. You keep him as a PEP as much as he has, by law, the right of immunity. Because when someone is a PEP, he is giving the right of immunity. For example, on the checkpoints on the airports, he can pass without being checked because he has the immunity, and he has the immunity because he is a PEP. So as far as by law he has the immunity, you consider him a PEP. But whenever he do no more have the immunity, no need to keep him as a PEP. So this is the main idea which I wanted to elaborate about the PEP. Now I move to the RBA, the risk-based approach. Let me initially say that in the financial sector, we have all of these risks which are in front of us. All of these risks, credit risk, market risk, liquidity risk, and so on. But the AML CFT risk is between, as you can see on the screen, is between the operational risk and the reputational risk. We have the AML CFT risk, and it's one of the major requirements of a successful, efficient AML CFT is the RBA, the risk-based approach. Regarding the RBA, I need to focus that, as you can see on this pyramid, it is international requirements. What you see on this pyramid, on the top is the law which is having the highest prevalence. International requirements by FATF, by the UN. When we say FATF, this means UN. Then this requirement, and the RBA is one of the requirements of the FATF, which is an international requirements, FATF number, recommendation number 12. It has, as this pyramid, it has to be articulated in the local constitution of the country itself, then in the law, in the decisions of the parliament. I'm going level by level from top to down in this pyramid, then in the decision of the ministers, and then in the decision of the central bank, and it reaches this department of the institutions. Let's say, for example, we are speaking about the bank. Every bank has to apply the RBA because it is an international requirement by FATF, that is international requirement by UN. Now, for the RBA, we have to set up 3 dimensions. I have my clients. I'm speaking, for example, in a bank. For each client, I have to set up his geography, his geographic presence, his residency, information about the clients, the customer, what is his profession, for example, and the product that the bank is selling, what are the anti-money laundering, combating the finance of terrorism risks, which are within these products which the bank is selling. Very important point that in risk, in RBA, what do we do the RBA setup in anti-money laundering for? To classify the risk of our clients or of our product. In the classification, we usually think that there is only 3 risks, the high, medium, low. No, this is not enough. We have also another category, which is the prohibited. That is, I am totally prohibited to deal with this client or in this product. For example, let's say that a client which is a resident in North Korea. North Korea, you know very well that it is under sanctions.
Yes.
So the bank is totally prohibited to deal with this client. So this is not a high risk, this is a prohibited parameter or a prohibited client in the setup of the RBA. Now, as you can see, you know that we said that we have the customer, the geography, and the product which had to be set up on the RBA. On the customer level, there are entities which are considered high risk, as banks, casinos, offshore, embassies, MSPs, virtual currency, car dealers, used car. On the geography matter, we have countries which are considered high risk. For example, the countries which are tax haven. Some countries are, for example, British Virgin Islands are considered tax haven. So if I have a client in my bank who is a resident in British Virgin Islands, so I consider him as high risk. My reference to identify the high risk geographies are the International Narcotics Control Strategy Report, point 1 in the screen, the Corruption Percentage Perceptions Index, this point number 1, point number 2, FATF, point number 3, or reference number 3, and we have the HIFCA, United States. They identified certain jurisdictions which are evaluated high risk. So these geographies are considered high risk. Now, in terms of products, some products are considered high risk. We have to check the following. Does it enable significant volume of transaction to occur rapidly? This product is considered high risk. Does it allow the product which are sold by the bank? Does it allow the customer to engage in transaction with minimal oversight? This is a high-risk product. Afford significant level of anonymity to the users. That is, we do not know the source of fund with whom we are dealing. This is considered high risk, and so on. So who does regulate? Who is the responsible to identify what is true and what is wrong in the setup of the RBA? These are the references: the European Union, the OECD, the FATF, then the Bank of International Settlement, Basel, then the Wolfsburg Group, then the local parliament of the country itself. Suppose I'm speaking about France. The parliament in France identified the law of anti-money laundering and what is risky and what is not risky. And then we reach the central bank of the local country where we are, and we reach upon FATF, the financial investigation unit. Every country, it has a financial investigation unit which helps in identifying the requirements of the risk identification in anti-money laundering. Now, in terms of onboarding, when we are onboarding any company or onboarding any individual, we have, in setting the RBA, we have to take into consideration on the individual level, the profession, the nationality, the residence, and the customer's nature. And on the legal level, if we are opening an account for a company, we have to take the residence, residence parameter, the customer nature parameter, and the legal status. That is, what is the legal structure of the company. And definitely, we have to screen the name of the individual and the name of the company, and we should be having an application to do these screening. So we have for individuals and for legal, that is, when I say legal entity, and when I say individual are the persons, the legal entity are the companies. And on daily basis, by this system, I have to check if his transactions, either individual or company, are similar to what he declared when he signed to open an account in his KYC. If there is deviation from the volume of transactions which he declared when he opened the account in the onboarding, then we have to do enhanced due diligence for this client. We end up by the following: to set up the RBA. Initially, first, we have to set up the core system, then create the risk matrix, what is high, medium, and low, and create the risk weight. I'll elaborate about it. And then run the risk-based approach and identify the rule-based approach, and then do the transaction-based approach, which I will be elaborating and explaining about. Now, once we reach the setup of the weight, as we can see here, for the individual, we reach a certain weight on 100 based on the criteria which I identified: his profession, legal status, nationality, residence, customer nature. So he will get a grade over 100 on the bottom of this table. If the grade below 33, it is low risk. Between 33 and 66, it is medium risk. And then above 66, it is high risk. This is the risk weight. Then we reach the rule-based approach. That is, I can identify that certain professions are definitely high risk. The offshore companies, non-face-to-face clients, companies established in countries tax haven, customers dealing only through intermediaries. All of those, the PEPs, all of those are considered high risk. Car traders, non-banking institutions, all of those are considered high risk. We call this the rule-based approach under the RBA. Everyone, for example, is money dealer, immediately I consider him as high risk. For example, the non-profit organization. And between parentheses, a remark, whomever is high risk does not mean that I should not deal with him. I can deal with him as a bank, as a financial institution, but I have to do enhanced due diligence in dealing with him. I have to be prudent. Now, for the transaction-based approach, if I monitor the transaction by the system, there are certain transactions which I realize that this client is doing them. This is considered high risk. This does not mean that I should not deal with this client. I can deal with him, but if there are certain patterns for the transactions of this client, this is considered high risk, and the RBA will consider it high risk. So I reiterate, RBA is the risk-based approach, how I classify the risk of my clients in terms of compliance risk and anti-money laundering, combating the finance of terrorism risk. For example, the first one, many cash in followed by one cash out. This is considered high risk. Many cash in followed by many cash out. This is considered high risk, and so on. This is the TBA, the transaction-based approach. I end up with the following. I set up the core system. This is now I am summarizing how do I set the risk-based approach for my financial institution. A, I set up the core system. B, I set up the risk matrix, high, medium, low. C, I set up the risk weight as I showed in the table. The client will be having a rate below 33, between 33 and 66, or above 66. Then the risk-based approach, then the rule-based approach, then the TBA, the transaction-based approach. We end up with high, medium, and low risk clients. Classification of my clients, either high or medium or low. This will lead that for those who are high risk, every 1 year, I have to review their KYC and make sure that their transactions are still similar to what they have declared. And I ask the client to confirm again his profile upon which I have generated my RBA. Those who are medium, I have every 3 to 4 years to review their KYC. And those who are low risk, every 5 to 6 years, I have to review their KYC. And that's it. Let me tell you, effectively in your question, you mentioned the word emotions many times. So this is the challenge and this is the solution. This matter is highly challenging. And the solution is only through one approach, which is training. We have to train our staff who are frontliners, who are going to deal with the PEPs. We have to train them about the delicate approach, how to deal with this PEP who is no longer a PEP, and now he is being faced with such high number or embarrassing number or surprising questions which might be embarrassing him. So in order to succeed in this challenge, we should know very well that it is the approach with these non-PEP who used to be PEPs, it should not be mechanical. That is, we should not go straight forward and go through the due diligence process and as if it is something mechanical. Definitely the reaction of the PEP might be that this client is not happy, is not satisfied, and he might break the relationship with us, with the financial institution. So the solution, it is challenging, and to succeed in this challenge, we have to train this staff who is dealing with this non-PEP, who used to be a PEP, how we have to train him, how to deal with him to get the necessary information and let this client be happy and satisfied, and how to let this succeed through training. But training about what? It's not about banking. It's not about finance. It's not about KYC. It's not about signing the application. Training about emotion.
Yes, exactly. That was my point.
So we have to do a specific training about how to deal with the emotions of the client when we're trying to attain from him the information which we are in need of. The science of compliance solution, it's becoming a science, and it is an obligatory solution which we should be having it into our financial institution. This started effectively in 1989 when the UN, through the OECD, through the FATF, declared the FATF requirements in 1989. At that time, and then it evolved. On 11 of September 2001, it was highly required to apply these compliance standards. Let me tell you, this was 1989, and you are aiming to be at this point that the system will not lead to any conflict with the client, to any emotional crash with the client. So this is what we are aiming to reach. The gap between the system and what we are aiming to reach was large in 1989. And we started to improve and update and make better approaches of the system to the client. and the gap started to become less than before. Okay, still we're having accidents, still we're having, but it is decreasing. We reached, let's say, 5 years ago, the AI decreased too much this gap. So there is still a gap, but it is much more less what it was in 1989. We
Exactly.
did not reach the zero.